Right now, if you bought $100,000 of shares or crypto, doubled it, and held for more than 12 months, you'd only be taxed on $50,000 of that gain. Half of it vanishes thanks to the 50% CGT discount, according to the ATO and the 2026 budget. But the 2026 budget says that discount is being replaced for gains arising after 1st July 2027. Most people have no idea how this discount works, or that the rules underneath it are about to shift. So let me show you the real mechanism. Here's the simple version. Capital gains tax is tax on your profit when you sell, and if you're an individual who held the asset more than 12 months, the ATO lets you have the taxable gain. But it's not as simple as it sounds. That discounted gain still gets added to your income and taxed at your marginal rate, and the 2026 budget says this entire discount is being replaced for gains arising after 1st July 2027. So let's break down each piece of how it actually works. Step 1 is the 12-month clock. The 50% discount only applies if you've held the asset for more than 12 months, according to the ATO's capital gains instructions. Sell even a day too early and you don't get a partial discount. You lose the entire concession and the full gain is taxable, which is why timing matters far more than most investors realize. Step 2 is where the discount actually bites. Once you've held past 12 months, the ATO includes only 50% of your capital gain in your taxable income. So a $100,000 gain is reported as just $50,000 per the ATO in the 2026 budget. That halving is why the CGT discount is one of the most valuable tax breaks available to ordinary investors. Step 3. That discounted gain gets added to the rest of your income and taxed at your marginal rate. The discount doesn't lower your tax rate, it just shrinks the amount that rate applies to. So a top bracket earner still pays their full rate, but only on $50,000 instead of $100,000, which is the whole reason this concession is so powerful. Now here's the big change. The 2026 budget says that for gains arising after 1st July 2027, the flat 50% discount is being replaced by inflation-based indexation plus a minimum 30% tax on gains. Instead of simply halving your profit, the new system strips out inflation first and then applies a minimum rate floor. A fundamentally different way of calculating what you owe. For anything you already hold when the change hits, there's a transition. The government says assets owned before 1st July 2027 and sold afterwards can use either a time apportionment method or a market valuation at 1st July 2027 to split old gains from new ones. And this matters for shares, ETFs, managed funds and crypto held outside super, which covers most everyday investors. A lot of people assume crypto sits in some separate tax world. It doesn't. Crypto is treated as a CGT asset, so the current 50% discount applies today and the post-2027 reforms apply to it too, since the changes cover growth assets outside super including cryptocurrency. That means the same 12-month clock and the same transitional valuation questions land on your crypto wallet. Here's the catch nobody puts in the headline. If you sit on a winning asset and sell it well after 1st July 2027 without any records, more of your gain can be pushed into the new regime where a 30% minimum tax may apply per the 2026 budget. And if you never captured a 1st July 2027 valuation, you may not be able to prove which part of the gain was earned under the old, more generous rules. Before I get to what this actually means for you, which is the most counterintuitive part of this whole thing, there's a quiet trap in the record keeping. To use the transitional split cleanly, the government says you'll need dated broker statements, exchange records, and ideally a market value captured right at 1st July 2027 for each asset you hold across the boundary. If this breakdown is useful, subscribe. There's one like it every week. Miss that snapshot and proving your pre-change gain becomes a real headache. So what does this mean for you? Take Mia. She's 38, earns $110,000, holds $85,000 in shares and $25,000 in crypto, and she's about 27 years from retirement. Under today's rules, gains held past 12 months may qualify for the 50% discount, but the ATO and budget make clear that if she waits and sells a winner after 1st July 2027, part of that gain may face the new 30% minimum tax framework instead of the discount. Here's the strongest, most practical takeaway, and I saved it for last. First, check your likely CGT outcome in My Tax using the ATO's capital gains instructions before you sell, so you find your net capital gain rather than being surprised at tax time. Second, value every asset you might hold across forward July 2027 using broker and exchange records. And third, compare each parcel's acquisition date so you decide what to sell before or after the change based on tax, not guesswork. The CGT discount you know today isn't guaranteed tomorrow, so the smartest thing you can do is get your records and valuations sorted before 1st July 2027. Next, I'm covering exactly how the new inflation indexation method calculates your tax step by step. If you want to catch that, subscribe so you don't miss it.